Hey, are you a business owner, entrepreneur, or professional? If so, we want you to apply to be a featured guest on our show. My name is Adam Torres, and I host the Mission Matters series of podcasts. I've recorded over 3,000 episodes, and we are just getting started. How do you know if you'd be a good guest to be on the show? Well, only one way to find out, and that's to apply, but I'm going to let you in on a little secret. We want guests that have a story to tell, guests with a brand, a product, or a service that can benefit my audience of listeners. If this sounds like you, go to missionmatters.com and click on Be Our Guest to apply. I'd love to talk to you and get to know more about your story. Again, head on over to missionmatters.com and click on Be Our Guest to apply. All right, now let's get into the show.
Hey, I'd like to welcome you to another episode of Mission Matters. My name is Adam Torres. You can follow me on Instagram at AskAdamTorres to keep up with all our releases. If you'd like to be a guest on Mission Matters, head on over to the website missionmatters.com and click on Be Our Guest to apply. All right, so today's guest is John Grace, and he's founder and president over at Investors Advantage Corp. John, welcome to the show.
Thank you, Adam. Good to be with you.
All right, John. So we have a lot of things to talk about today. I mean, you have a book, you have a successful firm that you've been running for a really long time. You're doing some really special stuff there at Investors Advantage Corp, and I want to get into that. But maybe just to get us started for the audience, let's go back to the beginning. So tell us about that John that was just getting into the industry. Like, what was that like?
Well, I don't know if you can tell, Adam, but my accent may reveal my origin. And of course, that I'm from the South. And by that, I mean South LA. And so part of the reason I mention that is because this whole notion of financial planning and, economic equality for so many of us is so daunting. And what I'm trying to say is I happen to be best man in a Jewish wedding. So the groom's father had me come over to the house in Marina del Rey. And he said he was willing to be my mentor. That was like 1979. And I should mention that just a year ago, guess what? I had a chance to have a phone call with the father's grandson in Seattle who wants to get in the business. And I know we can talk about that, but it became full circle. And I'm saying, geez, you didn't get to meet your grandfather because he passed away too soon. So I can tell you some stories about him, but now you're interested in getting in the business, and whatever I can do to help you get in the business, trust me, you can count on me, because if it weren't for him and your dad, I wouldn't be in the business. So that started around 1979, and we're delighted that we're still in business, and we happen to be part of a group called Elite Financial Network out of Southern California, where we manage about $800 million of assets under management. So we work with people who make a lot of money and people who are struggling to get by. And for me, that is satisfying because we are able to work with people from all walks of life to help them see what can be done to make the situation a little bit better.
No, I think that's wonderful. And I think we have somewhat of a similar path in that sense. Obviously, there's some difference in the years that these events took place. However, so where I'm from in Michigan, so Detroit, like I come from an area where, it's not necessarily the most financially literate area. It's not where they don't necessarily have all the resources that it takes to really get that solid background. And I remember how I got in the business originally. So, I mean, I've been removed now. Been full-time in media about 5 years, but I was in financial services for almost 14 years. And I ended up getting into the business because I asked my parents some pretty basic questions around finance, and they're okay with me sharing this story, by the way, and they didn't know the answer. And they're like, Adam, we're not really the best with money. And if you want to learn about money, you're probably going to need to go work with people or learn from people that have money. And so that's where I started my first position when I was 16 at Raymond James and Company. So I was there in their IRA department filing and doing all kinds of things, trying to figure out what an IRA was at that time. And I was able to, take some of that information and build a career from that. And obviously building as time went on. And so the reason why I share my story with you, which I don't always do, is really because I see those similarities, number one, but I do think there's something to be said for minorities being represented in the financial services industry in general. Can you speak to that a little bit and just kind of your experience and what you've seen?
Yes, I love your background as well, and I think it should be encouraging to all of us who have an interest that there is a way to get in the business. And by the way, this was an article, this is a long time ago, but it was in the Wall Street Journal. And it looked at what were the barriers to more minorities being in the financial services industry. And I thought their answer was spot on. And I would summarize by saying their best answer was lack of access. So, if you had an interest and your parents had a neighbor who was in the business, your dad or your mom would talk to the neighbor, and the neighbor would say, well, bring Adam in and let's see what we can do. Yeah. But if you don't have that kind of access, it's a more daunting task to find the person who might help you open the door. The good news is that the door has no barriers to it. It's hard to see the welcome mat, but there is one at the door. And I will say, particularly in the larger cities, whether you want to be behind the scenes as an individual getting into the financial services industry, or on the front line working directly with the representatives or the clients who are investing their hard-earned resources themselves, there is a place for you. You have to actually, of course, say, I am interested. But here's some good news. To the extent that you find it a good place to be, and you get the licenses, and you got to jump through the hoops and dance to the music. Yes, that's right. Yeah. But here's what my point is, that it's one where you can find a home, even if the job goes away or that particular company goes away. The community has a place for you. Again, whether it's behind the scenes or in front of the camera, so to speak. But there is a place for you if it's a place where you want to play.
No, I love it. It's great advice. And I love the industry personally, and the people that I've met and the friends. And I was at Lifer. I worked for 4 different companies when I was, and that was my first base and audience of people that watch like the content you're looking at right now, and and all those other things. Like, so the financial services industry, I always encourage young people. I always tell them that it's a great long-term profession. Sometimes it gets a bad rap, but that's just from people maybe that haven't had the right experience, or maybe they had one. And then you can have that in any profession. But I'll tell you, if you find your niche, and if you find, you search just like you need to do in anything, right? Yes. That you can find a real good home, like you said, in many different areas.
Well, and I think the key that I say to young people today, it wasn't as easy as becoming a 16-year-old, or I was 24, 25. It's gotten harder. But the first thing I submit that you should do, if you're interested in this as some kind of a career, is go look to see how much you can learn about the companies where you might like to work. What you're looking for is their culture. What you're looking for is how do they do business? And then you need to go to the mirror and look to see what's important to you. Is it commission, for example, in terms of compensation? Is a flat fee for assets under management? Does the banking structure look attractive to you? Would you prefer to be on the insurance side? Do you prefer to be on the independent side? Do you prefer that there be a lot of oversight in terms of what you can say and how you can say it? Frankly, Adam, it's funny because I've had some friends of mine say, geez, you seem to be just about everywhere. You're on this talk show and that talk show. And I can't do any of that. And I said, well, there's a simple explanation for that. And that is you might want to look at your business card, because there's some firms that you can be as bright as, a new light bulb, but they won't let you utter anything that you, in fact, what you have to do is repeat what you've been told, like you're a good puppy. So maybe that works for you. That would not work for me, but I happen to work with a firm where we're more on the independent side. And certainly we are counseled in terms of what we can say. But the good news is that one of the reasons that we bring clients in is because the clients get a chance to see whether or not what I'm saying to them makes sense to them, as opposed to be repeating what home office and the hierarchy has told me that I'm limited to say. So we actually get a chance for a real connection from the standpoint of, well, who are you and what do you believe and what does that mean to me? So I think that's a very important thing for people to do, to look to see where do you think a happy home might be. I think it makes it more likely that you'll find a home or you'll be near one that works for you short-term and long-term, as opposed to discovering you're in a system that really doesn't conform with how you think business should be done. And now you have to change firms, and that can be very challenging.
No, that's great. I think that's great advice. And the bottom line here is you have options. And the thing is with the access to information now, what has become easier is that you can find all these things out really easy nowadays. So you don't have to know somebody at every one of these firms to get the information. It's all public, and there's reviews and there's other things. So that's in my opinion, that's the big win, is that you can do a lot of the groundwork like in advance to even decide if you want to go down that path.
Exactly.
So John, I want to switch it up a bit. So let's get into, I mean, we're recording this right now just for everybody listening in Q1 of 2021. So 2020, big COVID year, I guess we'd say. So kind of a lost year here. And we're going into 2021 as the end of January. What kind of things are you seeing in the market? Like, what do you think investors should be considering right now?
Well, I would say, Adam, that 2020 was it started off first quarter, February 19th through March 23rd, if I'm not mistaken. The market was off like 34%, but the S&P 500 ended up about 16%. That's quite an anomaly. So what I would say, given that this pandemic is a disaster of epic proportions, in my opinion, 2020 was a bull market for stocks and a bear market for humans. Okay, It was a tough year, and according to me, 2021 started on January 20th because January 20th felt more like November 3rd, where this is how we do it in America. It's cool, calm, collected. We have some respect for each other, and we can take care of business. Those are encouraging signs. I mean, on election day, right? After hearing about all the drama that was going to unfold, it did not. We could put kids on buses and send them all to all the polling places across the country. And what did they see? Everything was working the way it was supposed to work. So hopefully, as I say, by starting on the 20th of January of this year for 2021, maybe we can really evaluate what's important to us as Americans, and then put ourselves on a path where we are more appreciative of what we do, more appreciative of who we are, and more appreciative of each other. And maybe we can be welcomed back to the world stage where we've kind of been dismissed because of how we acted. That's how I see it. So where are we from right here? A lot of uncertainty. And as you've seen just this week in terms of market volatility, I think that may be a sign of more to come. And looking at this whole notion with the GameStop and these day traders, this feels to me very similar to where we were like in 2000 to 2002. Yeah. And just to put that into perspective, what people don't, I think history is something we can learn from. Math is a good 4-letter word to use. Budgeting is okay to use. And history is okay to learn from. And I think as Americans, we tend to repeat history more than we learn from history. Yeah. But if we just go back to the late 90s, if you had $100,000 in your 401k, 403b, 457, and the brokerage account, and particularly if it was on NASDAQ in tech stocks, but if it was $100,000 starting value, say 1995, 96, by the end of that decade, you had $400,000 in NASDAQ, about $200,000 in the S&P, and $200,000 in the Dow. But for a 4-to-1 return in approximately 5 years, that was the game. But you were also hearing a lot about .com, right? Every company was a .com company, and none of them had any real sales or any real earnings. Kind of sound familiar with what's going on right now? We're all getting high on the hopium. So let's do the math here, because the good news is 100 went to 400. And then in short order, in roughly 30 months, 2000, roughly February, as I recall, to end of 2002, NASDAQ was off 80%. Let's do the math. Remember, and I encourage you to do it like this so that you can really see it. If account grew fourfold, 400,000 on 100, that's good. An 80% loss, 80% of 400 is 320. So 400,000 minus 320,000 leaves you with $80,000. Have a nice day. Okay. And for my peers will say, well, it always comes back. Yes, assuming you held on to the stocks that just got crushed and you didn't sell any and you didn't need the money, that account got back to even under those conditions in about 15 years or so. So maybe I think it's high time for investors not only to see what they're trying to do to either accumulate the kind of money they need to make work optional or to maintain the kind of money they need to keep work optional. The primary question that folks need to really answer, Adam, is what kind of loss can you accept? Now, don't get lost in the weeds of are you conservative, moderate, or aggressive. I think those are terms, for the most part, nobody understands. The person asking that question and the person answering that question. We don't have common definition for what is conservative, moderate, or aggressive, okay? And then what happens is we get, like I'm thinking about one good rocket scientist who said, well, my portfolio is very conservative. I'm looking at the portfolio and I'm going, you're 85% stocks, 15% bonds. That's generally not a working definition of what is conservative. This is aggressive. But notice we're not on the same wavelength. So to get on the same wavelength, let's actually determine, looking at the worst case scenario, both in terms of dollar amounts and percentages. We don't tend to resonate to percentages, but we do to dollar amounts. Again, 400,000, are you okay with an 80% loss? That's a darn good question. Because if you are, God bless you, good luck, who cares, okay, what your account does. But if on the other hand, you say, geez, looking at 2008, 2009, markets off 37%, many investors' accounts were off over 40%. Was there a way to limit your experience to, let's say, instead of being off 37 to over 40, your account might have been off hypothetically as much as 20%. If we're off 40, we need a 66% return to get back even. If we're off 20%, we need a 25% return to get back to even. So as we get ready for, Super Bowl Sunday on the 7th of February, do you really want your team to be set up to have to depend on an Hail Mary pass just to get back in the game? That calls for high drama. So let's see what we can do to limit the losses so that no matter what happens in the market, Adam, if it is the case that your account is doing what you can live with, then you can let whatever happens in the news blow up, let the market go down like the Titanic. But if you can see that your account's actually performing within what you hope to be your expectations and your reality, now you can have a little calm, but I think actually a lot of calm as the wheels are coming off the wagon.
Yeah, that's and I think this is a great transition. So I want to go into Investors Advantage Corp and really how you're helping investors and really the importance of the plan overall, because a lot of the things you said as you're talking, I'm kind of recalling some of the things in my career when I was in the business, and I'm like, well, I know how I skirted or I escaped 2002. I went to college in 2000. So I'm like, if you're going to college or you have a reason to be out of everything, hey, you're good. But that was complete luck. Before that, my very young eyes being there, I'm thinking, oh, investing's easy. You just put money in the market, and this would be what, 98. So this would be 98. And then that was when I was 16, and then going into college in 2000 when I graduated high school. So I'm like, oh, this is easy. During 98 and 2000, I'm like, oh, all you do is you just put money into a .com stock and it goes up. I got this figured out. Yeah, that's not the way it works. So tell us about.
Well, it does for a while, and then the music stops or the carousel, and everybody has to get off the carousel. The fun has ended. Okay?
Yeah. So let's get into Investors Advantage.
Luck is not a strategy. So yeah, you were fortunate enough, or you happen to be at the right age, and that's part of the equation. What's going on relative to what I'm doing? Because if I'm at the entry level, then all bets are off. I'm going to survive this. But if it is the case that I'm taking withdrawals, and if I hadn't taken withdrawals, it would have taken 15 years to get back to even. If I had taken withdrawals, would I have ever gotten back to even? The answer is probably no.
So let's get into Investors Advantage Corp. Tell us a little bit more about the company and really how you're helping investors.
Well, we did something that most of my peers don't do, and that is start paying back in 1999. As you were drying your ears, we were paying for independent research. And remember what I was talking about earlier, the system or the securities industry has a lot of hierarchies. So there's a lot of words and thoughts and patterns that you're expected to repeat. And in many cases, I would submit to you that our industry, again, I apologize for my peers because I can, being in the business since 1979, about the only message we have really conveyed successfully is buy and hold and hope, sit and take it. Okay. And as opposed to making a line in the sand from the standpoint, if you don't need the money, or you're young enough so that 15 years is not going to upset your apple cart, whatever the time frame it might be to get back to even, then it really doesn't matter what the market does. And in fact, you want the market to go down, frankly, while you're making contributions. You want to buy more shares as the price declines so that you can count more shells, if you will, as the tide has gone out, right, at the beach. And then you've got a bunch more shells than you would have, as opposed to when you can't collect them when the tide is in. So if you're not needing the money or you have a lot of time, then you can afford to just keep buying the dip and buying the lows and buying more shares. If, on the other hand, let's suppose it was your grandparents, I would say, maybe, Adam, and let's say grandpa had $1 million and retired in 2007, but he only needed in 2008 a withdrawal, just to keep the math very simple. 3% of $1 million is a whopping $30,000. We can all agree that's not a big drawdown in terms of income. But then the market hurricane, in some people's experience, was off more than 40%.
Yeah.
So if it were the case, let's say, just to keep it simple, the income was at 3%. Let's suppose the decline in some cases was more like 57%. Now that's a 60% drawdown or decline in value given the market hurricane and the withdrawal. What was $1 million minus 600,000 is suddenly 400,000. Oh, very different story.
Yeah.
And if this was a traditional retirement account, let's understand two things. Now, this is money you can't buy and hold. You must sell every year for the rest of your life to meet the required minimum distribution imposed by the Internal Revenue Service. And those withdrawals must do what? Increase every year for the rest of your life. Oh my goodness. So what was $1 million minus 600,000 is 400,000. And next year, the withdrawal rate goes up a little bit on 400,000. Now, as I say, what are your chances of full recovery? Probably zero. Yeah. Because every year you have to increase the withdrawal. So the hole's only getting bigger. My real point is we have to see the situation as it is. You know, help me to see it as it is, help me see it better than it is, and then inspire me to act. And the real question becomes, baby boomers, for the most part, are the ones in this economy that have the money. Can you afford the declines? Can you limit the declines so that maybe the account is off 10% or 11%? What is your threshold, if you will? First quarter 2020, market's off 35. If your account was off, say 10, for example, that means instead of needing, nearly certainly 40, if it was off 40, you need 60. If it was off 10, you need maybe 11. So clearly, by the hole not being so deep, you can see that I can recover and keep my sanity and let the market do whatever the market does. Because who knew that it would come back as strong as it did to finish 2020 up 16% after that February through March decline of 34, 35%.
So I know you've been doing a lot of work, again, dating this. So we're in, 2021, so COVID's still happening. I know you've been doing some work with financial planning for essential workers. And a big deal because a lot of times this population can be overlooked. So tell us a little bit more about your work there.
Because we have our clients, we think, pretty well squared away, as again, we pay for the independent research and applying what we've learned, reading different information at 3 o'clock in the morning because it's so different. We learned a lot in 87. We learned more in 2000. We learned 2008. We learned again fourth quarter 2018, and then first quarter 2020. So by virtue of having these kinds of conversations with our clients and having them, for example, I like to say that sometimes it's better to be lucky than good, right? Yeah. So we started going to clients in 2007, primarily because I was listening to somebody I thought was very bright, Adam. And this gentleman at one of the conferences said, we've had 150% loss early 2000. Suppose there's a second one in the same decade. And my new hire, my right-hand man now, the main math man, Daniel Medina, I looked at him and I said, that's a really good question. I haven't heard that question before. Maybe we should start looking at what we can do with our clients to help them see how they can be more defensive, because otherwise they're open to that kind of occurrence that happened before for it to happen again. So we started suggesting to people that we look at programs where the money's not passively invested, where you own the same number of shares, no matter what the market does. So that, let's say, '08, the percentage of the account that was in cash started the year of '08 at 5%, stayed the year at 5%. No. We would prefer that as the market's going down, instead of holding shares, we sell those shares, move that money out of risk assets into cash. And now the cash ratio goes from maybe 5% to 60% to 100%. It becomes defensive. Think of it as like wax on, wax off, the movie, right? Karate Kid. So in '08, when things are coming apart at the seams, if your account's staying at 5%, your prices are going like that, of the stocks or whatever your risk assets are. So to offset that, let's not hold the shares. Let's sell to cash, money market accounts. Maybe, as I say, finishing the year 60, 70, 100% in cash. And then starting around March 9th, which I think the S&P 500 was at 676, somewhere in that neighborhood. We're what, over 30, where? It's much farther than that, over 3,500. So if we had gotten, now that we have 60 to 100% in cash with this upward market volatility, now it's pedal to the metal. Deplete the cash balance back to 5%, become fully invested, in this case, 95% invested, 5% cash. So we limited the downside experience in a bad year. We want all of the growth in the good side starting 2009, really for the most part, till just about now. But again, we want these systems in place so that folks can see, regardless of how life is turning and how busy you might be, I don't have to try to reach you. You don't have to try and say, hey, we need to go to cash. The systems are built so that they automatically move to cash as the markets are coming apart at the seams. So that way you don't have to go crazy. So that's really the work that we like to see done for people who aren't 20 something and have another 30 years to recover. Because, if you're trying to spend it from grandpa 2008 for the next 20 or 30 years, we think it's more important to limit those losses so that grandpa can see this kind of consistent income without the drama, and he won't have to pull out whatever hair he might have left.
Let's talk about your, you have quite a bit out in terms of resources that you're doing to really educate the public and to really get your message out and just to give people the tools they need to make the right types of decisions about their investment future. So I know you have a podcast, you have a book. Let's start at the book. So tell us a little bit more about the book and also, how people can pick up a copy.
Sure. So I left out one piece to the question you asked for the last one, and that is what we're doing for the essential workers. And what I was trying to say is that because our clients are pretty well set up, we now, and we look at so many people, and these are generally minorities and women, and often millennials who are on the front line. They don't have the option of being able to work from home. They have to dress up, show up, and hit the job every day, and it puts their life in danger every day. So what we have done is, starting in September, we now provide. Last September, we now provide free financial planning services to frontline workers. You tell me you're a frontline worker, we'll spend 90 minutes with you on Zoom, and you'll have at no cost, and typically the cost, from what I understand, for most financial plans in America is about $2,000. You'll leave with knowing what your target is to make work optional, how much money you're going to need in the event a breadwinner passes away, because you might miss them, but you don't want to miss all of that money they were bringing home. And then if you have children in the equation, and now they have to prepare for college, how are we going to set it up so that they graduate, you cry, but you're crying not only because they finished, you're crying also because nobody has any debt. It is math, it takes some time, but it can be done. And in 90 minutes, that's the job we will do. So in terms of how can you reach us? Yes, the book works, Amazon or eBay, making finance make sense. We do have a radio show on Voice America, Fiscal Fitness, every Wednesday from 12 to 1. And for example, we sometimes will bring in guests. a couple of weeks ago, we brought in a really smart guy who was the only one who told me on November 3rd, long before the polls closed, that he was convinced Georgia was going to flip from red to blue, both for the White House and for the Senate. Now, it becomes a little more interesting because he so impressed me with his the clarity with which he was making the statement. I had to go out and look. And one of the things that most of us don't do is look at the demographic changes. And what I'm trying to say to you is that's one of the most important things we can study. And none of us have learned how to study demographics. It's part of the virtue of paying for this independent research, because when he made this declaration, I'm like, let me go see what's going on in Georgia. Because if you don't look, you won't know. And here's what I found. The couple of the counties that absolutely flipped from red to blue are now 30% African American, 20% Latino, and 15% Asian America. Let's see, that's 63%. So it wasn't the white suburban voter women that flipped so much as it was 63 of the population is minority, where in 1980 it was over 80% white. so this isn't so surprising given what we can see in terms of how the population has changed. So yeah, welcome to tune in there. Visit us at ybpoor.com. And let's see, what am I missing, Adam?
Tell us a little bit more about the podcast. I want to know more about the podcast, because a lot of people watching this right now are listening. I mean, they definitely love podcasts. So tell us a little bit more about the content they can expect.
Okay, well, our formula is to do what you aren't hearing. I don't know how many interviews I've been on, but you have maybe 5 minutes and they have one subject, and maybe you can get something across in terms of an idea that makes sense. Maybe not. The odds are not really that high. So we're not just looking at what the market did today. We will talk about what we have been seeing for the year. And one of the things that we want to keep our eyes on is the disparity between how the market, as far as the Dow is concerned, relative to the S&P and along with NASDAQ. Sometimes there's a lot of separation there. That's not good news. We also want to look to see how the volume is. To the extent that there is greater volume daily, as far as the stock market is concerned, everybody agrees that's a very good sign. If, on the other hand, we're seeing some things shift, like right now, I think we may be seeing a shift. We're saying to folks, look, we don't predict the future, but you don't have to predict the future to prepare for it. And one of the concepts that impresses me is our research team is now saying, notice in 2018, we saw a loss of 20%. Notice in 2020, we saw a loss of 35%. Please notice that the second loss was more severe than the first loss. So be not surprised to see another loss sometime 2021 that's more severe than those two. That might be the pattern that we're in. And they're suggesting that it could be as soon as maybe, I hate to put a time frame out there, because if it doesn't happen, then you look like an idiot. But I'm saying if it is the case that there's a 44% loss baked into the cake, some are suggesting that could be the first test to the south. So there may be a second one behind that. And the way I've tried to put it is, make believe there's going to be an earthquake this weekend. Are you ready? If it doesn't happen, you don't care, right? And if it happens, you can tell the story. That's what we want. Let the earthquake happen and you can tell your own story. So can you afford a 40% loss if it were to happen, or an 80% loss if it were to happen? And recognize that just as we talked about NASDAQ being off the 80% and requiring 15 years to get back to even, we want people to understand there are other examples of that. People say we're going to have a V-shaped recovery. And I go, well, it could be an L-shaped recovery. What's that? Well, remember after the Great Depression, it took like 25 years for stocks to come back. And some suggest it took 4 decades for real estate in New York City to come back. More recently, we see a similar pattern with Japan. Nikkei 225, the equivalent of our S&P 500, peaked, I believe, at 39,875, somewhere in that neighborhood, 1231.89. Last I looked this morning, the Nikkei was at 27,800. My point, the Nikkei has not gotten back to 39, 40,000 for 30 years. And guess what? Their real estate market followed the stock market being off a year later about 70%. And those prices in Japan aren't back to their high. So we work a lot with engineers, and engineers have a way, probably as you know, Adam, of saying, what's the worst case scenario? Let's look at that. Don't give me the sales stuff. Just tell me how bad it could get. Let's look at that. And if I can live with that, I'm good. But if I can't live with that, what can we do to put the odds more in my favor so that I think I can live with how bad it could get, as opposed to trying to pick up the pieces after the Humpty Dumpty has fallen and cracked.
Yeah. So final question, John. So if somebody is watching this right now and they want to listen to the podcast, or maybe they want to pick up the book, or just learn more about Investors Advantage Corp altogether, I mean, what's the best way for them to do those things?
Well, certainly we have a lot of material posted on our site, WhyBePoor, WhyBePoor. Try to make it simple for folks, right? And then, there's also a way to position the questions from the standpoint of, if you click on, are you ready for the pandemic? It will give you a series of questions so that you can see how much loss you can live with. And then we'll report back to you to say, now maybe you want to look at your portfolio. So that's probably the easiest way to see what we're up to. And yes, we are on Voice America. It's called Fiscal Fitness every Wednesday from 12 to 1 Pacific time.
Fantastic. Well, John, been great having you on the show today. Definitely a pleasure catching up with you and learning more about what you're doing to help investors. And to the audience, as always, thank you for tuning in. Hope you got a lot of value out of this. If you did, don't forget, hit that subscribe button. Definitely want you to be a return viewer and listener. Got a lot more great guests just like John coming up for you. And John, thanks again for coming on the show. It's been a pleasure.
My pleasure, Adam.